getting the most out of your 401k series. Today, what we're going to be talking about on day three is what are your investment options. So, this is going to help you understand not just what a 401k is, but also what are you actually buying when you buy an investment option. There's going to be some heavy vocabulary today, but that's okay. I'm not going to bog you down with the vocabulary. I just want you to kind of understand it. So as we go through these slides, if you see something you want to read more on, go ahead and pause me, read the slide. We may not look at the whole slide as we go through, but it's there for you to use and help you learn to understand. So let's get into this question of what are my investment options. So the very first thing you'll see here is there's really four types of investments that you can purchase in a 401k. The first one are stocks. Now, what stocks are is partial ownership of a company. Apple, for example, has 16 billion shares, over 16 billion shares of stock outstanding. Some companies have more, some have less. Actually, Apple is the largest in terms of that. So most companies have less. One share does not equal 1%. It just means one piece. Now, that piece can be anywhere from, if it's a small individually owned company, it could be 1% or 0.5%, or in my case, my one share is 100% of my company. But when you get up into the larger companies that you're going to be able to buy in your 401k, it's usually a very, very, very small sliver per share. You make money with stocks by when the stock goes up in value because the company goes up in value. Now, this really comes down to what people think the company is going to be worth in the future. So a really good example of this is back in the day, Johnny Carson, or maybe it was Jay Leno, interviewed Jeff Bezos, the founder of Amazon. And Amazon was becoming a very, very high valuation company. They were worth a lot of money at the time, but they had never made a profit. So while they had never made a profit, people wanted to own Amazon because they knew someday in the future Amazon would be a major player in the world. And this is where we're at today. So people back then took the risk to buy a company that didn't make a profit, hoping it would grow and appreciate and one day make a profit. Most companies, though, their pricing and what they're worth is directly related to the profit that they make. So companies that don't make a profit usually don't have a very high worth for long. But as a company gets more profit, they become more profitable, the stock value becomes more profitable, and that's where you make money. The second category are bonds. So if you look at bonds, we've got that right here. What bonds are is, instead of ownership, what with stocks are sometimes called equities, bonds are debt. Bonds are where you have actually lent money to the company. So for example, Coca-Cola is a well-known company for buying bonds. And the way it works is you loan them some money, and then they pay you an interest rate at a schedule that they agreed to in advance, usually every 6 months. So you may get 4% a year, half of it every 6 months, and maybe it's a 5-year bond. Well, at the end of the 5 years, they'll give you your money back. You don't get any of the principal back during that period. You just get interest payments back, but then at the very end, they give it all back to you. Typically, when you buy a bond, each bond is $1,000. So if I give $1,000 to Coca-Cola, they agree to pay me what is called a 4% coupon, or a 4% interest rate. Then every 6 months, they're going to give me $200. $20. I should do my math right. Every 6 months, they're going to give me $20. And that $20 for each bond, I'm going to be able to keep, and I'm going to be able to do anything I want with it. At the end of say it was a 5-year period, at the end of that 5-year period, that bond will be refunded in full. So you'll get your full $1,000 back. And that's how bonds work. You give them the money, they make the payments, and then at the agreed upon time, they give you the money back. If we were to do this use the same terms as we used for you, if you took out a loan, it would be called a balloon payment. Interest only for the period, and then a balloon at the end to pay all the principal back. And those are bonds. We'll go in a little more depth on those in the future in just a couple minutes, but that's a good overview. You understand more about bonds and stocks than most people do. Then you have a third category. We call those cash equivalents. Now, cash equivalents are anything that typically doesn't see a fluctuation in value. So you're not going to lose money. You might earn a little bit of interest. These are things like money markets, CDs, or even really short-term notes, typically 3 months or less. So think of a bond that is going to pay you back in full within less than 3 months. That's kind of what you're looking at when we talk about cash equivalents. And then you don't see it very often, but sometimes you'll actually see the option to buy an insurance or an annuity policy in a 401k. It's there from time to time. We'll touch on it because sometimes it does happen, but it's not very common. Now, typically, as you go from left to right on the screen, you'll see more common to less common. So as you look at your stock options, you may have 15 or 16 different, and we'll go into mutual funds in a minute. You may have 15 or 16 different mutual funds with stocks. You may have 3 or 4 bonds, 1 cash equivalent, and maybe an insurance option, but most often, no. It's a rare thing, but it does occur. So now let's go a little bit deeper, and let's talk about all these different things and how do we balance the risk? Because one of the things we talk about in investing is risk. Now, what risk means in most cases when we talk about investing, it means the chance that you'll lose your money. Now, a lot of times, though, it's not necessarily the chance that you'll lose your money forever. It's how much of a chance do you have of losing your money for a short period of time? So it's volatility. It's how much does it go up, and then how much does it go down, and how quick does it go up, or how quick does it go down? So when we look over here, we have high risk high risk categories are more towards the top, lower risk categories are more towards the bottom. So, but then you can even break that down. So you can look here, we've got higher return in the upper right-hand corner of your screen, our high return. These are your growth stocks or maybe your small cap stocks. So you might see a phrase growth fund or small cap fund, or you may see a tech fund or health tech fund, healthcare technology fund. All of these things tell you that they're going to be higher risk. Your ups are going to be bigger and your downs are going to be bigger. It's really a good long-term investment, not a short-term. You don't want to be in these for less than 3 to 5 years. But if you can put your money in and leave it there, they're a really good place to be. Taking a little bit of a step back on the risk spectrum, you go over into what are called value stocks. Now, those are in the top left. They're still stocks, so they're still up or down. These are the ones that when you watch the news at the end of the day and they talk about the S&P 500, the S&P 500 are value stocks. It's the 500 of the largest stocks in America, and they're value. They tend to pay dividends, whereas growth stocks tend to take their profit and reinvest their profit. Value stocks take their profit and they send it to you as a dividend. Now, if it's in a 401k, it just buys you more shares. Okay, because you want that money to grow. They're lower risk than growth stocks. So while I put here low risk, they're low risk in relation to other stocks, not necessarily in relation to everything. So you still can see ups, you can still see downs, you're still going to see a good long-term growth return, but they're not going to grow as fast as your small cap and tech stocks, and not going to go up and down as quick as Tesla or Apple. They're going to go a little more just right along the path. Sort of think Ford, GM, GE, these type of companies. All right, so those are your stocks, and those are the more risky ones. So I kind of have a line here in the middle. That line in the middle delineates between stocks and lower risk investments. So when we talk about lower risk investments, we talk about things like money markets and CDs and bonds and fixed annuities. These are types of things that have lower risk, but you're going to get a lower return. So think about it this way. If you go to the bank today and you try and put $50,000 in, you might get a 2 or maybe 3% interest rate, but you're not going to lose your money. Whereas in the market, if you put your money in, you're hoping for a 7-8% rate of return, but you have a higher risk that money goes down. This is the difference. These things are what we would call capital preservation. They want to just preserve your money. They don't want to make you any more. Maybe you'll get a little bit of interest, but really they're there to kind of help you just keep your money. You really should avoid, most people should avoid, and this is one of those that will throw that disclaimer on there again, right? For informational purposes only, seek professional advice. But you really should avoid having too much of your 401k below this line, especially the younger you are. So anyone who's less than 3 to 5 years out needs to have more exposure into above the line. And quite frankly, if you're 65 and you're retiring this year, you still want to be above the line with a good chunk of your portfolio, because you're probably going to live well into your 80s, not just 67 or 68. So you've got more than 2 or 3 years. So we really want to be above the line more than below the line. But if there's a specific reason you're going to be pulling the money out in the near future, you could be below the line. And then we've got one other category here that I've got it kind of as high risk, low return, and these are your variable annuities. Generally speaking, I'm not a fan of variable annuities. They have an area where they do work for people in certain areas, and I have used them for people. But generally, the person who does the best with a variable annuity is the insurance agent who sold it. They can pay, same with fixed indexed annuities, which we'll get into a little bit in a couple minutes. But they can pay anywhere from 4% to 20% commission rates. So that's really the person who's making the money on is the insurance company and the commissionable agent. But there are situations where variable annuities can become useful if you're using them specifically to pay for a fixed expense that's not going to change in the future. But that's enough about that. That just gives you an idea that generally what you're thinking of when you're thinking of investing is you're thinking, how much risk do I want to take on in order to get the return? Because as you take on risk, you're going to get return. You should get return in response. And as you take less risk, you're going to give up return. So the question is, how much risk am I willing to take in order to get the amount of return I need? That's your question. All right. So now let's go into stocks a little bit more, just so you understand a little bit about how stocks work and some of the tech and some of the terminology involved in stocks. Wanted to give you this quick run through. This kind of walks you through. We're going to start right up here in this square, the life cycle of a company in the stocks. First, a company is founded. So think about Amazon as an example. We'll stick with Amazon. Amazon is founded in his garage. He starts selling books online, starts to actually see a decent amount of sales, grows to the point to where he's making money. So now Jeff Bezos, I wanted to say Bill Gates, but Jeff Bezos is making money. He's doing really well. He has this now option of either keep my baby small or take on more money and make it really big. So they do what is called going public. Now, going public isn't necessarily the first time they've taken on investors, but is the time they'll take on the most investors. This is where they take it from a privately held company with maybe him and anyone else who's invested in just him. And now everyone can buy into it. Anyone who buys into the stock market can buy it. So when you go public, you take a chunk of your business and you tell everyone it's available for you. Now it's listed on the stock market after that point. And it may be listed on the NYSE, New York Stock Exchange. It may be listed on what's called the NASDAQ, or it may just be an over-the-counter one that you find on your own. But it's now publicly owned instead of privately owned. During this period, the stock's price is whatever the buyers and the sellers agree upon. So it's really a free market situation. So however much, when you look at the end of the day, it tells you that the stock closing price of $45.83, that's not an Amazon price, just something I'm pulling up. That just means that was the last price for the day that someone agreed to both buy and sell, so that we're able to make a transaction. Think of it as buying a used car. You go to buy the used car, and as a buyer, you have a number in head. You think this car is worth $5,000 and not a penny more. And as a seller, the seller has a number in their head, and they think this car is worth $6,000 and not a penny less. Well, in that case, no one's going to buy. So we don't really know what the value of that car is until it sells. Now, once it sells, maybe you and them settle on $5,500. The value of the car is $5,500 because you've agreed to it. So it goes public. It trades on the market. Shareholders can buy or sell the stock, and the stock is priced based upon what people agree to. So the stock price is the agreed upon value. The stock valuation, though, is what it's actually worth in terms of the company's profit. For a long time, Amazon had no valuation because they were worth nothing according to their profit. We measure this in a few different numbers. My favorite is what's called the PE ratio, the price to earnings. How much are you paying for how much of the profit are you getting? That's all it boils down to. The price to earning affects the price, but it's also affected based on this box here. It's affected based on a prediction of future profits. What do we think it's going to earn in the future? So for example, when Amazon had a zero valuation because they were not making profit, they had zero for this valuation portion, and all of their stock price was built off of future predictions, what they thought it would be worth in the future, how much profit they thought the company would make in the future. You may also earn dividends or shares, or sell your shares. Earning dividends means if the company makes a profit, they take it and they give it out to you. They just send you a check. Selling your shares is the other way that you can get your money out. You can just be like, I'm done, sell my shares, and you get your money back. So those are stocks. That's kind of how the stock market works. Bonds, on the other hand, function a little bit differently. And I forgot I had this slide. I should have been looking. Stocks, not only did we go through that flow, but they really break down into two different categories. There's the capitalization, or how big a company is, and then there's whether it's a value or a growth fund. So when we look at large cap companies are your big companies. They're the big multinational companies that you think of every day: Amazon, Apple, Microsoft, Google, Ford, GM. All these big companies that are multinational, they're all over the place. Those are all American large cap stocks. Mid caps are your smaller stocks. Maybe they're only national, or even maybe a super regional, multiple states. Your small cap stocks are small companies, but they're not like mom and pop shops. They're like small companies, like a regional bank or things along those lines would be in that small cap field. So it has to do with, when you hear about capitalization, large, mid, or small, it has to do with the size of the company. When you hear value, blend, or growth, this is the second category it could be in. Growth means the profits are going to be reinvested. Value means profits are going to be sent out as a dividend. Blend means they're going to do a little bit of both. Now, even in a value company, they're not going to send out all their profit. They're going to keep a portion of it, but they're going to send a portion of it out to you also. Blend, they're going to do a little bit of both. They're going to both send you a check, and they're going to try and develop new technologies. So that's the difference between the types of investments you have in terms of stocks and how we categorize stocks. So now let's talk about bonds. Bonds can be a little more complex. They don't return a great amount in terms of investments, but they pay interest. So we talked a little bit about it. Let's kind of recap. The issuer is the company or the institution buying that is offering the bond. So they're the people that are saying, I would like to borrow money. The issuer borrows money. A par value is what they issue it. It's the original price of a bond. So they may offer $1,000 bond, and they may offer 1,000 of them, and they're asking to borrow $1 million. 1,000 bonds at $1,000 each is $1 million of borrowing power. Par value is that $1,000 it starts at. Now, market value is what the bond is worth on any given day. So we'll talk about how bonds are priced in just a minute if you want to buy them or sell them after they're initially issued. But know that bonds can change and fluctuate with value. And on any given day, your market value is what it's worth at that very moment. Maturity is the life of the bond. So if it's a 5-year maturity, it's a 5-year bond. You may also talk about maturity date. The maturity date is the day that it comes due, that you get your initial investment back. Duration is the time remaining on the bond. So if you're 2 years in of a 5-year bond, your duration is 3. That's how much time is left. Coupon is the interest rate. It's what they're going to pay you. The yield is a combination of the interest rate plus the market volatility, the market price. So if your market price is higher than $1,000, it's going to make your yield go down. If your market price is lower than $1,000, your yield will go up, and we'll explain that in a minute. And callable means that they have the opportunity to pay the loan off early. If it's a callable loan, they can pay the loan off early. If it is not a callable loan, they cannot pay it off early. Now, generally speaking, in a 401k, you're not going to need a lot of these terms when you're buying bonds, but it's just good to kind of know. So let's go ahead and let's talk about how do bonds work. Company, we're going to use Coca-Cola. They decide we want to raise $1 million, so they're going to have $1,000 par value. You as a person are going to buy this bond for $1,000. Think of it as a piece of paper that says Coca-Cola owes you $1,000. You're buying an IOU. You're going to hold it. During the holding period, they're going to pay you every 6 months the interest rate, the coupon that is on it. And when it matures, you get your $1,000 back. So you're living off of the interest, waiting for the repayment. Now, as prices go down, your yield goes up. So this is what I want you to think about when it comes to bonds. Interest rates going up hurts you if you own bonds. Interest rates going down helps you if you own bonds. So think about it this way. You give $1,000 to Coca-Cola, they're going to pay you 4%. A couple years later, interest rates are higher. So now instead of 4%, if Coca-Cola wants to borrow, they have to pay 5%. Well, am I going to buy your bond when I can go to Coca-Cola and get one for 5%? Probably not. So in order to sell it, you have to lower your price. Now, lowering the price will help what's called the yield increase. And what the yield is essentially it's what rate of return you're going to get on the remaining payments plus the final payout compared to the price that I'm paying. So if I'm paying $1,100, then my yield is going to be lower than if I were just paying $1,000. So all you really need to know is as market rates change, interest rates go up or down, the value of the bond side of your portfolio is going to go the opposite way. So right now we see interest rates going up and we're seeing bonds going down. Now this only really matters if you sell the bond early. If you hold it till maturity, it doesn't hurt you either way because you're going to still get what you were originally agreed to when you bought the bond. Now, that's all the nuts and bolts. And the nuts and bolts are great. They're fine to know. But what you want to understand is you're not going to go into your 401k and buy a specific bond or buy a specific stock. It's very rare. What you're going to buy is a mutual fund or maybe an exchange traded fund. And while they're not the same from a technical perspective, like on the back side and inside the box is the same of a mutual fund and an ETF. For all intents and purposes on your end, we're going to talk about them as though they're the same, but just know there's some nuts and bolts in how they function that they're not. What is a mutual fund? Well, a mutual fund is simply just an investment that is mutually funded by a lot of people. So you buy some, I buy some, and then everyone else that owns this fund buys some. And now, instead of me having my $20,000 and you having your $20,000 or $500,000 or whatever your number is, now we can all come together and we can buy stock in lots of millions or even maybe tens of millions or hundreds of millions of dollars. And by doing that, now where you could maybe have only bought 2 or 3 companies, you can buy all 500 of the S&P 500 because you're buying it in this mutual fund or ETF. The advantage to that is when we look at this, if you're having a mutual fund, your fund might own Apple, it might own Ford, it might own Microsoft. It's going to have all these other little ones around here, probably going to hold 400 or 500 stocks, maybe 200 or 300 in the minimal size. There are a few that have smaller, but generally speaking, they're going to hold a lot of holdings. Now imagine if you had all of your money in Microsoft and Microsoft went bankrupt. When I was in my early 20s, really early 20s, there were 2 major bankruptcies that occurred. There was a company called Enron and a company called WorldCom that went bankrupt. They were big companies that just all of a sudden overnight went away. Well, a lot of people were really hurt by that, not because the company went away, because their 401k was in a company stock. Well, if they had their money in this mutual fund, then they might have lost 1% of their holdings, but they would have still had everything else. So in most mutual funds, the largest holding is going to be somewhere around maybe 2 or maybe 3%. So if Apple dies one day, your mutual funds are only going to go down maybe 2 or 3% because of that. This is how a mutual fund works. It allows for more buying power and greater diversification. Diversification is the number of things you actually hold. So what you might see is you might see that in your 401k, you've picked 3 mutual funds, but inside of those mutual funds, you're going to have multiple hundred investment options. And they could have a lot of overlap too, so you want to make sure you're not overlapping. Diversification in and of itself doesn't help, but good diversification that doesn't have overlapping inside of their funds, because you might buy these 2 funds and they're 90% the same while you're not as diversified as you think. But that's what a mutual fund is going to do. It's going to help you to buy more investments than you would normally be able to do, so that if something goes bad on one, if Apple loses half of its share, or Tesla goes bankrupt, or Amazon would have been a flop, you would have been okay. So mutual funds are what you're going to be buying in your 401k in most cases. Now let's talk about the other thing that you can buy, which are annuities. There's generally 3 kinds. There are fixed annuities, and there are variable annuities, and fixed indexed annuities, or just indexed annuities. Let's talk about them at the far ends first. Fixed annuity pays a flat interest rate. They'll often say there's no cost. The truth of the matter is there is a cost. You just don't see it. And that cost is what interest rate you would get managing the money on your own versus what interest rate they're paying. And they keep that difference. So basically the cost of it is the profit on their money that you give them minus what they're actually going to pay you in interest. And because all they're going to do is they're going to take it, they're going to buy some bonds. And if their bonds are earning 4%, they'll promise you that they'll give you 2%. So that 2% difference is the cost. All right. Variable annuities, on the other hand, what you're doing with a variable annuity is you're giving your money to an insurance company, because all annuities are insurance products. You give your money to an insurance company. They take that money and they give you what are called sub-accounts. Now, sub-accounts are again, function for all practical purposes like a mutual fund. Now, there's some taxes and some nuts and bolts on the backside that you'll never see that make them technically different than mutual funds. But they have this list of mutual funds. So you have all the risks that a mutual fund comes with. They charge an M&E, which is just an insurance fee. They charge rider fees to give you added benefits, and those fees could give you some form of cushion so that you won't lose all your money maybe. They vary widely, and they can be very expensive. So generally, when we talk about risk, a fixed annuity is going to give you the risk of inflation. So if inflation occurs, the dollar loses value and things become more expensive, a fixed annuity is still going to pay you what it paid you. A variable annuity gives you a little bit of an advantage because it can go up faster than a fixed annuity, can receive more growth, but the fees give such a drag on it that you're probably never going to keep up with the market as a whole. So a fixed annuity is very, very safe. A variable annuity is a little more aggressive, but really high fees and usually not a good idea. They have this middle thing called a fixed indexed annuity, and you'd think, wow, this sounds like it's right in the middle. It's also not a great idea for most people. Again, throw that ever popular disclosure that we always throw up there, for information purposes only. Please consult a professional. You would throw that out there again. But fixed index annuities, what they do is they promise you no less than 0 rate of return, so you're not going to lose your money. But then they'll tell you, pick an investment. So you pick the S&P 500, and they'll say, all right, if the S&P 500 earns 2%, you get 2%. If the S&P 500 earns 5%, you get 5. If it earns 9, you get 5. So they'll cap the amount. And it might be a cap at 5%, it might be a cap at 6%, it might be a cap at 4%. But they'll give you your interest based on what the market does. If the market goes down, you don't lose money, you just don't gain any money. So they're often sold to people with the perspective of, hey, you can have upside of the market if the market does good, but none of the downside. Well, again, that's not true, because you could still be earning money by being in, if the market goes down, you could still be earning money by being in a bond portfolio. So there are costs involved in this, but again, they're going to tell you there's no cost. It's just, again, what they earn minus what they pay you is the cost. And in some years, that can be very sizable. All right. So that's kind of the annuity talk, cash equivalents. This is just your CDs. They're things designed to not lose money. We talked about it early. Their big risk is inflation. If cost of living goes up, these things are not going to keep up, and you're going to lose money, though you don't feel it, though you don't see it. You'll feel it, but you won't see it. Think about it this way. If you're trying to save for a car and you've been putting away money and you're getting a 2% interest rate, but the price of cars is going up by 8, you're not making any grounds. You're actually losing grounds. So you want to be careful about how much you put into cash, because retirement should be long term, should be far off and long reaching. So with your retirement money, you really want to make a lot of growth on it, but you want to make controlled growth. This gives you kind of a start. Now, our next session, what we're going to actually talk about is how do I actually pick my investments? So with all this stuff that I just overviewed, the next question is, how do we pick the investments that are right for me? I'm going to help you out with that. Now, if you want some hand holding, you want some personal assistance with you, I do offer a portfolio assistance program. I call it the 401k Max program, where what we will do is review your investments, help you set up your investment goals, build you what's called an investment portfolio, investment policy statement, which is how do I pick what investments they are. Then we'll build your portfolio. It's about it's 2 meetings long usually. It takes only maybe of your time, maybe only takes about an hour and a half of your time. You gather all the information, we find out what you want to do, and then the second meeting we present it to you. It's a $500, and you can book on our website, www.saveforyourfamily.com. If you found this video useful, please check out the next one and also share it with anyone that you think could also use it. Hope you have